right, everybody, Don Winter here. We're going to go ahead and get started. Thanks for joining us on a Thursday evening. What we're going to be talking about here is multifamily real estate investing, why we think this is the best strategy there is in real estate, and maybe in any asset class, how you can invest alongside of us and alongside of myself in the equity fund too. So with that said, we're going to go ahead and get started. So if this is the first time you're on a webinar with us, then this will probably resonate with you. If you've seen this before, if you're one of our existing investors, sorry. But I think this is really critical to understand how we look at the world of real estate investing here at DLP, both in terms of this multifamily investing strategy as well as investing in general. And our principles here are do not lose money ever, consistent returns, and we do that by investing in what we know at a deep level. And then our third rule and our last rule is refer back to rule number one. Those are pretty simple investment principles, and we feel this B and C class multifamily strategy we focus on really resonates with this focus. And you'll hear more about that, and that'll make a little bit better sense as we move forward here. A little bit about myself. Again, if this is the first time hearing it, hopefully they find this valuable. Again, apologize to our many existing investors on here tonight who know a little bit about us already. But I've been in real estate for about 12 years. I'm the founder and CEO at the DLP family of companies. We've now closed over 6,000 real estate transactions, over $1 billion, including over 1,000 acquisitions, 1,000 properties we've purchased. Ranked by the Wall Street Journal as the #9 real estate professional in the U.S., #1 in PA, New Jersey for the past 5 years. And again, I'm the CEO of our family of companies. That data on the bottom there is a little off in that we now own over 5,000 apartments and homes, about 5,200, about $425 million in assets. And then you can see on the left there are my two little boys who are 5 and 6, my wife Carla, and a big part of my life and my priorities there on the screen. So a little overview on us. As I go through this tonight, if you say this is great, but there's a lot of information, how do I learn more? If you go to dlpcrowd.com, if you haven't been there already, you can create an account. It literally takes 15 to 20 seconds. And you can see all of our actual performance reports, financial audits, all of our fund documents, everything you could want to see about us to do more due diligence, to get more comfortable with who we are, how we invest, and how we've performed over the years. Here's an overview of where our properties are located. As you'll notice there on the left is the number of properties and loans that we have in each state. In the middle are just the properties we own, and on the right are just the loans that we have funded. The other side of our business, our lending business. You'll notice a lot of assets throughout the Southeast and the Northeast, which is where we're predominantly focused. Here's where we operate, where we have offices in. I'm talking to you right now from 564 Market Street there in St. Augustine. We have a couple offices here in St. Augustine, Florida. Our headquarters in Bethlehem, Pennsylvania, the top left, and we have a few other offices throughout Florida, New Jersey, and Pennsylvania, as you can see. This is our leadership team. A couple new faces here for anybody who's been with us a little while. A couple things that I'll highlight here briefly. Jason Battistelli, who was our Senior Vice President of DLP Property Management, as of Tuesday is now the Chief Operating Officer across the DLP family of companies. We brought in Harlan Krishman as our President of DLP Property Management. He was previously President of Resource Residential, one of the largest, I think they were the 4th largest property management company in the country. So 2 key additions that just joined us here this past week, as well as Mary Conlin as our Senior Asset Manager. So 3 key new additions to our team, helping us continue to handle our growth and continue to execute at a high level. So a little overview of the fund, and then I'll get into how the fund works. I'm going to get into the strategy, get into multifamily investing in detail here. So here's how our Equity Fund 2 works. This fund has been open for a little over a year. It closes on March 31st, meaning we're taking commitments only from now to March 31st, and this fund will be closed to investments. The goal of this fund is to generate a 17% annual net return to investors, that's net to investors, with 7 to 8% paid out on a quarterly basis from cash flow, from rental income, and the rest of the return paid out at the end of the fund through capital proceeds. through selling off the assets. So essentially, half the returns will get paid out through the operations of the fund, and then half of the returns will get paid out at the end when we wind down the fund. It's an 8 to 10 year fund. Realistically, from now, we expect this fund will be open for another 6 to 8 years. So if you invest in this fund, you're going to be looking at a horizon of about 6 to 8 years to have your money invested with us. You can redeem out with 180 days notice, but you'd go into this fund looking for a longer term investment that's going to provide you with a great high yield return, good cash flow, and tax shelters through depreciation. Nearly all, if not all, of the returns that we're going to pay out to you will be deferred from tax through depreciation, which is pretty significant. We can talk a little bit more about later. So what we do in the equity fund too is we buy multifamily real estate, or in other words, apartment communities. We buy them and we improve them or stabilize them. Primarily, we're buying 100 to 500 unit apartment communities. Our current largest community is 404 units, but we're under contract right now on a community for 419 units. Again, predominantly 100 to 500 units. Sort of our bread and butter is around 200 units, high 100s, 200, 220 units in that type of range. We're focusing on B and C class apartments, which I'll explain what that means further in a moment. And then most of the properties we buy are what we consider to be value add, which means the property has potential to increase the performance. Often that's needs physical improvements as well as usually management improvements as well. So how we go about mitigating risk is, remember, as I started off saying, our number one focus here is no losses ever, and number two is generating consistent returns. So in order to do that, you have to go about mitigating risk, and one of the best ways we do that is through our strong in-house management. Currently, we are the management company on all of our portfolio, on all 5,000 plus units we own, and provide really phenomenal in-house management, great alignment with our investors as we own and treat all of our assets as units we own in our portfolio. So we'll talk a little bit more about that, but that's a critical aspect in our ability to execute is our in-house management. Another big way we mitigate risk is through disciplined buying. So right now, the multifamily industry is arguably the hottest industry in real estate. There's so much money chasing this strategy, chasing and trying to invest in apartments for good reason, because it's a great strategy today and very likely to be for as far out into the future as any of us can realistically look. And because there's so much capital trying to go into this space, it creates tremendous demand, which anytime there's tremendous demand, it often drives up pricing. And for these types of properties we're buying, they're often trading or selling in the low 5s to low 6 cap rates, which means if you bought the property for all cash, you would get a 5 to a 6% return on investment if you operate it really effectively. We focus on buying where we're generating at least an 8.5% cap rate, which means we're paying significantly less for the same assets, which is much harder to do. I'm a big believer that by paying more doesn't mean you win, and being willing to outpay other people to buy deals is not a strong way to invest, and does not ensure strong returns over the long haul. So that's what a lot of people are doing in today's market, and with the great leverage available today, you can end up okay. But long term, buying at those kind of prices, we don't believe is a great strategy. We really focus on conservative investing, buying at pricing that we can be in good shape in all markets, whether we go into a recessionary environment, we're going to be able to be in good shape. We have room for error, we have room for market changes, and that's a big focus for us. Another way we mitigate risk, and this is one of the most common questions people ask me about, well, how are interest rates going to affect things? Since we're using leverage, we're using financing, what if interest rates go up? And one of the biggest ways we mitigate risk is we lock in long-term, non-recourse loans on our properties. So typically we're locking in a fixed interest rate for 7 to 12 years, meaning that even if interest rates go up next year in 2 years or 5 years, our interest rates are fixed. They're going to be locked in at the rates that we are at today, or when we commit to the loan, versus being exposed to increases in rates. So if rates go up for us, in a lot of ways, it's a good thing, especially when we're buying, because it's actually the seller who suffers when rates go up, as we're going to use our same valuation model. We're going to need to get to our returns, which means we're going to have to buy deals at lower prices when rates go up. So for us, rates increasing really has little effect on us and our yield. And in many ways, actually creates a lot of opportunity for us in a whole lot of ways. But in short, we focus on locking in our debt that avoids us being exposed to changes in interest rates. Another big part of how we mitigate risk is investing in markets we know and understand and have good overall economics that we'll talk about. This gives you an overview to what we focus on. So we're buying B and C class apartments, which I'll explain further. 2 to 25 million typically. Most of our deals are in the $7 to $20 million range, 100 to 500 units. Right now, we have been buying in Florida, Georgia, North Carolina, South Carolina, Mississippi, Alabama, as well as Pennsylvania and New Jersey, but predominantly the Southeast. And we're focused on at least an 8.5% cap rate, as I talked about a little bit earlier, by the time we get the property stabilized, which usually takes us about a year. That in turn generates at least a 12% cash on cash return from rental income and at least an 18% IRR, internal rate of return over the course of our investment. As again, our goal is to pay our investors at least a 17% net return to our investors. This is what our process looks like to go about buying those types of deals. So if you said right now, all right, Don, that sounds good. So who wouldn't want to buy those properties, or why doesn't everybody buy those types of properties with those kind of return targets? Is it takes a lot of work. It's not, those types of deals are not available out in the open market. As I said, the market typically properties are selling in the 5s to low 6 cap rates, which means basically they're selling for 50% higher prices than what we're willing to pay. So in order to get those types of deals, it requires a lot of work on our. So on a monthly basis, we look at 300 to 500 deals every month. We then take about 40 to 50 properties into full evaluation, where we're underwriting all the financials, we're completing an investment analysis, we're pulling third-party underwriting reports, we're studying the rental market, we're analyzing local crime, we're spending a lot of time analyzing the asset and the market. Then about half of those deals, at least 20 to 30 deals a month, we're actually physically then going out to the company, or out to the property, which often requires us, flying or bringing our team in from different parts of the East Coast, where our underwriting team is located, and often walking through a large percentage of the units, walking some of the competing communities, meeting the tenants, understanding the management, understanding how they screen tenants, the quality of the tenants, going through the financials, et cetera. So we're doing that, roughly a deal a day that we're going out and evaluating, spending money, time, energy. And then out of those deals, about 15 to 20 of them every month, we put an offer in, and about 2 or 3 of those offers end up getting accepted. And then once they get accepted, we go through and walk through every single unit. We do what's called a lease audit, where we go through every single lease file. We go to the codes office, the police stations. We get insurance bids. We get third-party reports on the condition, environmental reports, you name it. We go through and make sure there's nothing we missed in our original underwriting, adjust our expectations, or adjust our pricing if a new issue does arise, or terminate the deal if it's an issue we can't get comfortable with. And then about 2/3 of those deals, essentially 1 or 2 of those deals every month, gets all the way to the point of us closing that property, onboarding it, and then managing that asset and producing returns. So thousands of hours go into each property we buy every month to make sure we're getting the very best deals, and that we're fully understanding the deal, the asset, before we close. And that's the amount of effort it takes to get the kind of deals that we're buying each and every month. In addition, then once we buy the properties, a lot of our properties require heavy lifting. So very often we're coming in and we're renovating apartments. We're demoing out the apartments. We're putting in new kitchens, new bathrooms, ceiling fans, new doors, paint, flooring. So example, this is a community we bought about 6 months ago. It's a 200 unit, 199 unit apartment community. And about 100 of the apartments looked pretty much just like those pictures. They were fully gutted, in really, really rough shape. And this is what they look like now. So you can see, came into completely gutted units and renovate them. So you can imagine in a community where half the apartments were in that kind of condition, the type of tenants you're going to attract to the other units, the feel of the community when half the community is vacant. And now to come in there and renovate these units and put in, all new appliances, nice kitchens, a little bit higher end cabinets, central air, hard surface flooring. The difference in the type of tenant we're able to attract and retain, and of course the rents we're able to collect. So we came into a community here where the average rent was about $450. Now our average rents are over $700. So it gives you an example to the type of heavy lifting we do. Then typically we're also dealing with a lot of management inefficiencies as well, which I'll touch a little bit further on. So with that said, you may be thinking, all right, this all sounds great, but why? You can invest in retail, office. Many people know, we started our career in single family. A lot of different investment strategies in the world of real estate. Why invest in multifamily? Why should you be considering investing in multifamily versus all the other strategies out there? So first, why we focus on multifamily, why we think it's such an amazing strategy today and for the foreseeable future is a couple of fundamentals. So first, rentership is on the rise. So homeownership went from about 69% now down to about 61%, which that might not sound significant, but that's millions of homeowners who went from being owners to renters. And most economists predict that decline will continue. Home ownership is also now starting later in life. So the average first-time home buyer now is nearly 38 years old. So people are staying renters longer. So even those who do want to be homeowners or will become homeowners are doing so much later in life. We're in a much more transient society that probably doesn't surprise most of you. People don't stay at their jobs as long. They don't stay in the places they live as long. They want more flexibility, which rentership provides. And the trends of the overall society culture that's expected to continue as well. With all that said, the next question or next focus of narrowed down focus of investing in multifamily that we look at is we narrow down our focus to really focusing on the South and even more specifically investing in the Southeast of the United States. So predominantly Florida, Georgia, North Carolina, South Carolina. And the reason we really like these markets and why we think these are some of the best markets, if not the best markets to invest in the country, are for these strong fundamentals. Strong job growth. So the best job growth in the entire country is in the Southeast by far. A lot of the secondary and tertiary markets we invest in, meaning not the primary markets like Atlanta. Instead of investing in Atlanta, we're investing in Warner Robins, and we're investing in Macon, Georgia. We're investing in Columbus, Georgia, Brunswick, Georgia. There's phenomenal manufacturing job growth in those markets, and the type of apartments we own are the type of the affordability that people who are working in these jobs that are being created can afford. Jacksonville, Florida, which is about a half hour from where I'm at right now, is the fourth best job market in the U.S. Tremendous job growth going on, but predominantly those jobs are in the $15 to $20 an hour range. Which is the prototypical income of the type of apartments that we focus on, which I'll talk more about. In addition to great job growth, there's also phenomenal population growth. So of course, strong job growth brings population growth, but also in these markets are often also places where there's a lot of retirement as well. And some of the best markets. South Carolina, I believe, has the best population growth in the entire country. Florida is in the top 5. North Carolina is in the top 5 or 6. So phenomenal population growth, phenomenal job growth, and both of those create, of course, strong demand. And with all the demand and all the population growth, there is no new product, which I'll talk more about. So that hopefully makes the case of why we invest in the South and the Southeast. So then the next narrowed down kind of focus of what we invest in is B and C class apartments, as you've heard me say a few times. So if you've never heard of that before, not familiar exactly what that means, basically what that means is we're buying apartment communities that are not luxury in quality. Typically that means we're buying apartment communities built before the early 2000s. Often we're buying properties built in the 70s and 80s, early 90s. Often these communities do not have all the amenities of new communities. They don't have elevators. They don't have all the amenities sometimes of clubhouses and fitness centers and so forth. And then because they're older assets lacking less amenities, the rents are of course much lower, which is one of the many reasons why we think this is a great place to be, which I'll touch more on. So B and C class apartments are amazing because there's no new supply, literally zero. So since 2010, there's been 7 million new housing units built in the US, brand new housing units built. That's single family and multifamily in the entire country. So 7 million homes were built, homes and apartments were built in the last 7 years or so. Zero were B and C class. Zero in the entire United States. So everything being built is Class A. You can't afford to build apartment communities that are not Class A due to the cost of construction. So everything being built is Class A, meaning rents are much higher. Average Class A rent in a market like Jacksonville is $1,800 a month. So in Jacksonville, Florida, there are thousands of apartments being built right now. Their average rents are $1,800 a month for a one-bedroom apartment. Our average rent is $800. That's a huge delta, huge gap. And that person making $15, $20 an hour, making $40,000 a year, cannot afford $1,800 a month. Income has not grown anywhere near the pace that rent has grown. In many markets in the US, rent has gone up 70 to 100% since the quote unquote Great Recession, yet incomes have been stagnant. That trend is not likely to change in any drastic manner. Incomes are not going to rise to nearly the pace that rents have risen and are likely to continue to rise. So there are people living in $1,800 a month apartments who truly can't afford it and are living off of credit cards or off of debt. But I believe when we go into the next recessionary environment and confidence isn't as high, debt's not as easy, credit isn't as easy to obtain, that people are going to realize that they have to move into something more affordable. Since there is no new product that's affordable, it creates amazing demand for the B and C class apartments in most of these markets. So great job growth, great population growth, and no new product is a really good formula for a long-term strategy. And we believe in some of the Class A markets, there is a lot of markets, there is a lot of Class A being built, and there could be a situation where there's more supply than demand, especially in a recessionary environment. But that's not going to happen. At least we don't believe that's going to happen in B and C class in the types of markets we're investing in that have good population growth. So really all investing, and certainly real estate and multifamily is no different. It's about supply and demand. And if there's an imbalance and there's more demand than supply, that's going to always put you in a good position. And that's why we really focus on B and C class in the Southeast. In addition, we get better pricing on these properties. We get better cash flow. As I mentioned before, the market's often in the 5 and 6 cap rates for B and C class apartments. It's often in the 4 and 5% on Class A. So we're getting better pricing in general and in a better position, we believe, long term. So the equity fund 2 right now that owns strictly multifamily apartment communities currently owns $140 million in apartment communities. That's 2,267 apartments. We currently have a 419 unit community in Columbia, South Carolina, pending purchase this quarter right now. That'll bring us to about 2,700 units. This fund closes for investment commitments on March 31st, meaning you will not be able to invest into the fund after March 31st. We will use the money that gets invested over this quarter to acquire properties really throughout the rest of 2018. And then the fund will stop making new investments. We'll focus on maximizing the existing portfolio, which will end up likely being somewhere between 3,000 to 4,000 apartments. And then the fund will wind down and sell its assets between 2023 and 2026 with a target of delivering a 17% net return to investors while distributing great cash flow deferred from tax throughout operation. To give you a little bit more color on what the fund owns, this is the first property that we purchased last year, which is a 96-unit apartment community in Titusville, Florida. This is a bunch of communities. I'm just going to kind of skim through these quick just to give you a little feel. This community does have a pool. It's a 2-story block construction property built in the 1960s, I believe. This gives you a little overview of it. These were our second, third, and fourth communities we purchased, all in Warner Robins, Georgia. We bought as a portfolio, a little under 200 units, 196 units. We purchased middle of last year. This was our fifth community we purchased in Conway, South Carolina, near Myrtle Beach, 64-unit community, a little bit smaller than we typically buy, but it's a market we really wanted to get into. This was our sixth community we purchased, 304-unit property built in the 1990s in Hattiesburg, Mississippi. One of our nicer communities, you can see some nice, has two pools, big outdoor fireplace, some pretty good amenities, but a lot of upside. This was our seventh community we purchased in Wilson, North Carolina, 100-unit single-story apartment community. This is our eighth property in Augusta, Georgia, 120 units. We bought this property, 126 units, along with the next one, which is 120 units from this in the same time, two properties in Augusta, Georgia. Our 10th acquisition was actually our 10th, 11th, 12th, and 13th acquisition were four communities we purchased the end of last year in Mississippi and Alabama, 1,086 apartments for $87 million. For solid B plus communities. And here's a little overview of where those are located. This is our 14th community we purchased, which was just this past Friday, a 95-unit community in Spartansburg, South Carolina. Great market. We own a 176-unit community right around the corner. And then we also purchased this community at the exact same day from the same seller called Iris Glen in Conyers, Georgia. These communities are both Cardinal communities, which are single-story communities built by a builder called Cardinal Builders. We own now 9 of these communities. They're all pretty much identical. We really like these communities for a whole lot of reasons, and really great asset in that they attract older tenant base who stay a lot longer. As you can see, they're all single-story, easier to maintain. Usually with private porches, as you can kind of see there in the front, and typically you only have one or at most two neighbors, so it gives you more of a community feel, more of a home feel, and attracts a better, stronger tenant base who stays a lot longer. What we really like is this was our 15th community we purchased. So this here kind of gives you a map of so a lot of the communities I just showed you, plus some of the other communities that we own here at DLP outside of this fund. So in total, over 5,000 units now. So again, to recap the fund itself, the fund has a maximum term of 10 years. Likely, we have 6 to 8 years remaining in the fund. Our goal is to distribute out to investors 7 to 9% returns from cash flow. So roughly 2% return per quarter, distributions paid out quarterly. So if you invest $500,000, our goal is to distribute to you $10,000 each quarter through operations. Most of that cash flow, if not all of it, will be deferred from tax through depreciation. And then at the end of the fund, when we wind down the portfolio, our focus is to distribute to a total return of 17% net of our fees on your investment. So essentially, you earn 8-9% return on your investment each year. And at the end of the fund, you're going to return back somewhere around 2 to 2.5 times your original investment. Last couple items, and then I'll open it up here to questions. Again, if you have questions as we're chatting, you can type in some questions in the chat box, which a number of you have done, which I will start addressing in a moment. You can invest directly through your brokerage account into the equity fund too. You can also invest through your IRA. One of the most common questions that I always get, so I figured I'd list it out here as a frequently asked questions, is how do we get to this 17% return? What are we assuming in terms of appreciation, in terms of what's going to happen in the market? And this is a really big question because there's a lot of different ways that you can analyze an investment opportunity. And if I went and said to you, all right, we're assuming that rents are going to go up 7% a year for the next 8 years, well, it's very easy to end up generating a really high return if you make that kind of assumption. And although that's maybe realistic, that is what has happened the last 8 or 9 years, we don't feel that that's a conservative approach in how we go about assuming what's going to happen over the course of this fund. We take a very conservative approach to our assumptions. So the assumptions we make are, first of all, we're buying properties at least an 8.5% cap rate that generate a 12% cash-on-cash return from operations. we assume that rent's going to only increase by 2% a year, which again, in most markets over the last decade, rents have gone up 6 to 10% a year. But we don't think that that's a conservative approach, so we assume rents will only go up 2% a year. And then the same token, we assume that expenses will also go up 2% a year. We also assume, actually, and you could argue, depreciation, in that we assume that if I could sell a community today at a 6 cap rate, that when it comes time for us to sell that property in 6 years or 7 years, that we're going to be able to sell it only for 7.5 cap rate. Or if today we could sell it for a 7 cap rate, we're going to assume that when it comes time to sell it, we're only going to be able to sell it for 8.5%. So basically, we assume that the demand is going to be much lower and that the pricing that people are willing to pay for communities is going to be much softer. People aren't going to be willing to pay as strong of prices as they are today. Do I think that that's actually going to be the case? No, I think the market's going to remain very strong, but we feel that assuming more historical cap rates, more conservative cap rates, again, puts us, of course, in a much better position that if we can sell at a 6 cap rate or 6.5 cap rate, of course, our returns are going to go up dramatically. We also don't assume that interest rates are going to stay as low as they are today. We do assume that there's going to be an increase in interest rates of 1.5% from where they are today. With all of those assumptions, we have to end up at over a 20% IRR on any property we buy. Usually we end up in the mid-20s, which then gives us additional cushion that even if we have an error in an assumption or the property doesn't perform as well as we hoped in a certain area, we can't get the rent growth we wanted, or expenses are a little higher than we hoped for, still gives us some cushion to be able to generate that 17% return net to investors. So before I open up to questions, I'm going to mention a couple of quick things. We have 2 investor dinners coming up. So April 5th, we'll be meeting, we'll be holding investor dinner a couple of feet from where I'm located right now at the Palencia Club here in St. Augustine, Florida at 6:30 p.m. A great opportunity for prospective investors to come out, meet many of our existing investors, get a lot more color to how we operate, meet many of our key team members. And then April 26th is going to be our big quarterly event in Bethlehem, Pennsylvania at the Blue Grill House, where we'll have a prospective investor get-together just like on April 5th. Plus, we do our quarterly investor-only get-together where we go over all of our performance for the previous quarter. So if you're in Florida or Pennsylvania or willing to make a trip in, we'd love to host you at either locations and set you up at one of our properties and have you come join us. And you can go to dlpcapitalevent.com. You can see there on the bottom, dlpcapitalevent.com, and register. Bring your significant other, bring a guest, and come have a good time. Free events, and hopefully learn a little something and have a good night out. So with that said, I'm going to open it up to questions. I'm going to go ahead and take everybody off mute. Sometimes that doesn't work well because people forget to put themselves on mute, so I'm going to attempt it. But feel free to also type your questions in the chat box, which some of you have already done, and I'm going to start getting to those questions here in a second. So I'm going to take everybody off mute. All right, so you're not on mute on my end anymore. So if you have yourself on mute, you still are, but you're able to now take yourself off of mute and ask any questions verbally how you like. So I'm going to open the floor up to verbal questions, and then I'll fill in with written questions as we go as well.
Is this a museum? UPS driver. It is a very unique. I mean, I love your house. It's a very unique house.
Somebody's got a TV on in the background, so if that happens to be you, put yourself on mute. There we go. All right. So while people are, he's always the first person to talk. It's always a little hard, but feel free to step up. I'll start answering some of the written questions. Will you be opening another equity fund, and when? Short answer is yes. We will open an additional quote-unquote equity fund 3. It's going to be called the DLP PREF fund, or Preferred Return Equity Fund. We will open that fund in Q2. The return target of that fund will actually likely be a little bit less than this existing fund. And one of the big reasons to not wait for that fund is, what's great about this fund is we've now already acquired 70–80% of the apartments and the properties we're going to buy. So you know what you're investing into. The portfolio is already generating great cash flow. So you get to kind of step into a portfolio and a proven fund versus going into a brand new fund that doesn't yet have cash flow or assets acquired. So great question, Joe. Are the properties mortgaged, and what percentage is mortgaged? Yes, absolutely. We do utilize bank financing. We do utilize leverage. Typically, we end up in our first year of a property at about a 65 to 70% leverage. So, meaning we have 30 to 35% of the capital is equity, the fund's investments, as well as my own money, which I co-invest into every property we buy with the fund. Um, but then typically as the fund, as we improve the properties, we put capital into them to renovate the apartments. We improve the value through better management and performance. Our actual portfolio of holdings is about a 53, 54% LTV, loan to value. Um, so hopefully that gives you color. Happy to dive into more details there. If distributions are reinvested, can they be reinvested into the new equity fund? Um, yeah, so good question. So you can reinvest, as we talked about. Our goal is to distribute out, 8 to 9% cash flow through operations. As long as the fund is still making investments, as long as the equity fund too has a place to put your money, assets to invest that money into, you can actually reinvest right into the fund on a quarterly basis. If you're not looking for income, you're looking for growth. After the fund is done making investments and we don't have no more need within the fund for capital, then you would have the ability to, instead of taking the distributions, to have those distributions then in turn get invested into any of our other funds instead. So if you're not looking for distributions, there's always an ability to reinvest those distributions into one of our funds. All right, next question. What is the last call to invest in equity fund two? So March 31st. So you have to have your commitment made by March 31st, meaning you sign the investment docs. We don't necessarily need the capital by March 31st. So if you said, hey, Don, I really want to do this, but I got money tied up, or I got to pull it out, I have to sell a property, whatever the case is, you don't need to have the money to us by March 31st necessarily. You just need to have made the commitment. And we could take the money in then, because we're going to likely take us a few months to deploy all the money that's going to come in over the next 6 weeks. So likely you'd have to April, May, June, maybe even July to actually make the investment if you didn't have the money free yet. But we need to take the commitments in by a deadline of March 31st. So great question. All right, great. Well, next steps here, if you're interested, this recording will get sent out if there's anything you didn't catch. You can also go to DLP Crowd, learn more about the fund, see the performance as well. And then certainly you can follow up with myself, Larry, or Bob for more information or take next steps with moving forward with the fund. And hopefully I'll see most of you at one of our events here in April. So make it a great evening, everybody. Thank you.